Hello everybody, today I'm going to walk you through a real quick video in terms of ratio analysis. We're going to focus this video on liquidity ratios. So there's a variety of different liquidity ratios. We're going to focus mainly on two of the most common ratios we'll look at. And one's going to be referred to as the quick ratio, and the other one's going to be looked at as the current ratio. Very similar, but here these are just going to really reflect how well a company is able to meet its short-term obligations. So let's start and let's look at a couple different ones. So like I said, liquidity ratios, really used to judge how well a company is going to be able to meet its short-term commitments or short-term obligations. And so, when we look at these guys, we have two real simple ratios here we can look at. There's some other liquidity ratios like the cash ratio or the cash conversion cycle. Those are also looking at how well a company is able to generate cash to meet some of its short-term obligations. But here, the two most common, the current ratio and the quick ratio, and very, very straightforward. In the current ratio, we're going to take the current assets the company has. So those are the current assets divided by the current liabilities. So this is going to give you some sort of ratio, and typically this is going to say, for every $1 in liabilities, this is going to give us a certain amount of current assets, which will be able to help us, pay these liabilities. Because remember, current assets are really, cash or other, assets that can be readily turned into cash. So, let's say if we had a company that came out and the current ratio came out to be, let's say it was $2, so $2.10. If we'd made this calculation, and the current ratio came out to be $2.10, what does this mean? This means that the company has $2.10 of assets available for every $1 of current liabilities. So then the next question is, well, is that current ratio, good or bad? Well, really, it's dependent upon the company and dependent upon the industry in which they're in. So typically, we obviously want to have current assets that do exceed current liabilities. We need that cash. We need that, assets to meet our short-term obligations. But we don't want this too high either. Okay, so if we had a company and this company had $20 of current assets for every $1 of liabilities, well, they may not be doing a real great job in terms of managing their short-term cash in their balance sheet, really, because maybe this money is better suited invested somewhere else in the company, not sitting in some current asset that's probably really not returning any sort of return to shareholders or to the owners of the company. And so it's very dependent upon what sort of industry someone is in, like in terms of the company, because potentially there could be different constraints positioned for those different industries. So typically we do like to see a ratio 2-to-1 is fairly good, but depending on the industry, these can be interpreted in a couple different ways. The second one we can see here is a quick ratio, and simply this is going to be exactly the same as what we saw in the current ratio, but now we're gonna minus inventory from the equation, from the numerator, the current asset portion, and we're going to remove this inventory. Why are we going to remove this inventory? Because potentially inventory may not be as liquid as some other assets or current assets, right? It may be hard to convert that inventory into cash very quickly. So this current quick ratio, is usually more conservative test of the ability for the company to meet its current obligations. And so then again, we go back, well, what's good, what's bad? Well, a 1-to-1 position or a one quick ratio is definitely seen as a good thing. They have enough current assets outside of their inventory to meet their current obligations. But again, it's going to be very dependent upon what type of industry someone is in. Maybe the inventory that a firm, maybe the inventory within the firm can be changed and converted into cash very quickly. Potentially there might be other industries where it's very hard to convert that inventory into cash. So we always want to be able to compare and contrast these to firms within the same industry that have a similar capital structure. And so those are two real basic liquidity ratios. And again, remember, these liquidity ratios are really used to judge a company's ability to meet its short-term commitments. And like I said, there's some other different liquidity ratios, but these two guys, the current and the quick ratio, are the two most important. So I hope that kind of helps you walk through a little bit of an understanding of what those two ratios do. If you do have comments or questions, leave them in the comment box below, and I'll try to get back to those as soon as possible. Thanks for watching.